One thing that happens in a portfolio is you end up with portfolio effects. The distribution of outcomes is not equal. You'll have outliers to the up and to the downside. So you have this constant capital allocation problem of your own time and attention, and certainly financial capital of what are we doing? How am I handling this group of businesses that I have? Which ones are growing? Which ones have challenges? And so you get this very different week or month or year of entrepreneurial operating when you're balancing kind of capital allocation as your primary challenge versus the focused company entrepreneur who's just going to grow their one thing. They've got this one boulder to push up a hill. I'm pushing 6 of them, but I'm running back and forth to whichever one is rolling backwards the fastest to try to get it to stop, while some of them are just taking off like a rocket ship up the hill.
Welcome to the Lay of the Land podcast, where we are exploring what people are building in Cleveland and throughout Northeast Ohio. I am your host, Jeffrey Stern, and today I had the real pleasure of speaking with Kelcey Lehrich, co-founder and CEO of 365 Holdings. Based in Akron, Ohio, 365 acquires and operates consumer product companies with a focus on e-commerce and a goal of long-term ownership. In our conversation, Kelcey shares his path to entrepreneurship and evolution from his first acquisition to becoming a seasoned operator, weaving in lessons from challenging ventures along the way, unconventional acquisitions, and the earned wisdom of building durable businesses in the competitive world of e-commerce. We unpack how Kelcey thinks about demand creation versus demand capture and what it takes to build a durable holding company in the first place, the trade-offs of a centralized shared services model and a decentralized holding company, building the best long-term home for brands, wisdom on what makes a company worth buying in the first place, and lessons learned from organizing the HoldCo Conference, the unconference of micro private equity here in Cleveland, and a whole lot more. Kelcey is full of insight for anyone thinking about entrepreneurship through acquisition, or is just curious about how to thoughtfully scale something of quality over time. So please enjoy this awesome conversation with Kelcey Lehrich. Lay of the Land is brought to you and is proudly sponsored by Roundstone Insurance. Headquartered in Rocky River, Ohio, Roundstone shares Lay of the Land's same passion for bold ideas and lasting impact from our community's entrepreneurs, innovators, and leaders. Since 2005, Roundstone has pioneered a self-funded captive health insurance model that delivers robust savings for small and medium-sized businesses. They are part of the solution to rising healthcare costs, helping employers offer affordable, high-quality care while driving job creation and economic growth throughout Northeast Ohio. Like many of the voices featured on Lay of the Land, including Roundstone's founder and CEO Mike Schroeder, Roundstone believes entrepreneurship, innovation, and community to be the cornerstones of progress. To learn more about how Roundstone is transforming employee health benefits by empowering employers to save thousands in per employee per year healthcare costs, please visit roundstoneinsurance.com. Roundstone Insurance, built for entrepreneurs, backed by innovation, committed to Cleveland. I think having kind of reviewed a lot of your work and other presentations of your own story, it sounds like you've been entrepreneurial your whole life. And I'm always curious about the origins of the enterprising spirit within people, and would love to understand when you felt that was unlocked within yourself. When did you come to recognize it?
If you were to look at any like personality profiling or assessment tool, you'd probably say it was inevitable. But I distinctly remember sometime, probably my sophomore year of college, I had a stint at Lakeland in Kirtland Hills. A professor mentioning 2 books that I went out and bought as a sophomore, so I was probably 19 or 20 years old. That's when I first read Rich Dad Poor Dad by Robert Kiyosaki and Multiple Streams of Income by David Allen. I was like, this entrepreneurship stuff sounds great. I don't know why I would go get a job. I'm sure those books were helpful. Again, I think it was probably inevitable given my personality that I would make for a very bad employee in most organizations. But there's certainly some very obvious, very early roots with things I was interested in early on. After college, I never had an actual like salaried job or career. I was bouncing around from different entrepreneurial things for quite some time until I kind of found my footing. And it started early.
As you were finding your footing, how did some of those pre-career, early career entrepreneurial wanderings, kind of shape your outlook? What was your approach to trying to find your footing?
I think I had just an incredibly high risk tolerance and willingness to work really hard for a while. So I didn't have a lot of fun in my 20s. I don't think my wife and I took like a real vacation until like our late 20s, despite being married for quite some time. I think I was just really committed to wanting to do my own thing, and that kind of matched my risk tolerance and my willingness to put in just a lot of hours. And I was going to figure it out.
Yeah. Well, where from that, kind of marrying the tolerance for risk with the work ethic to just kind of figure it out, did you arrive at the opportunity to acquire other companies? Like where does that kind of
Yeah,
play
so in
into?
those early entrepreneurial journeys, I had a stint in and around the franchising world. So I worked for some franchisors as an outsourced franchise salesperson, and so I kind of like the idea of helping people get into business for themselves and look at startup business plans in the franchising context. I ended up networking my way to an organization in town that was a business brokerage, so selling small businesses here regionally. And I ended up buying the business brokerage from the business brokerage founder on an earnout,
Oh, well.
began brokering small companies. Don't think I made a lot of money doing that. I was probably very young and very naive, but I certainly gave it a run and sold a few deals over a few years. But I realized kind of quickly that as a business model, even the worst business that I sold was a better asset than the asset of owning a business brokerage. Revenue is incredibly lumpy, very hard to forecast demand, hard to scale. Just lots of challenges. It's a very boutique kind of consulting little service business. And I quickly found myself wanting to get into other businesses. So my now partner today, he and I started buying small companies for thousands or tens of thousands of dollars, many times through seller notes or through friends and family money. And we just kind of started building a little collection of these little companies that individually were kind of just side hustles, but together could scrap together a living for the two of us with the overhead of a laptop and a cell phone.
How did you know how to do any of that?
I don't know. I just figured it out. Yeah, I think selling and strategy and spreadsheets and basic business models just isn't a difficult thing for me personally.
Mm-hmm.
And again, I always had the risk tolerance and work ethic to kind of figure it out. So opportunity always was appealing, and I was willing to go pursue it.
Did you have at that point with your partner a vision that 365 Holdings might develop into this platform holding company, or how are you approaching, I guess, the day-to-day versus the long-term strategy of it?
Ironically, there's always an interest to do multiple things. We always had more than one thing going on. And for years, people were like, you should focus. You should pick one thing and really go all in on it. And we've done the exact opposite of that. And it's worked out pretty well for us, I think. But e-commerce was not an early part of that formula, but having a holding company or having a portfolio of businesses, probably back to that kind of early reading in college of multiple streams of income and Robert Kiyosaki and some of those things. I think that was always interesting to me. Kind of the entrepreneur in town that had a lot of things going on. That just seemed like a fun way to do things. I certainly have a low amount of patience and a hard time focusing and a lack of attention to detail. So of course, like pushing one boulder up a hill is not as much fun as pushing up six at one time. We should push up six at one time. And here we are. It's worked out okay.
So at what point does 365 Holdings come into existence? What's kind of, how do you think about the founding and origins?
Yeah, so Justin, my partner, and I, we had assembled this little ragtag group of a half dozen or so little service businesses. And we finally sold one for $100,000, which was just enough money to be a 10% down payment on $1 million SBA loan. So I went shopping for $1 million business. I ended up getting on every business broker's email list I could find, look at all kinds of things. Ended up finding an e-commerce business that had a low multiple, a lot of cash flow, a small team, and a ready to sell, ready to exit owner. And between an SBA loan, our cash, and a seller note, we had a deal made. With that deal, we got a line of credit, and we didn't take a whole lot of cash out of that business early on. So about 90 days after buying that company, we maxed the line of credit and took all the cash that we had generated in 90 days and went and bought another one with a seller note and kind of just over levered again. And I think at some point I was like, we have these two e-commerce businesses now. I'll do a couple million in revenue in the next 12 months. We probably should talk to our lawyer or attorney about some kind of holding company or structure to put on top of this.
Yeah.
And there was a 8-minute conversation that was I don't know, just pick some name. Nobody's ever going to see it. It's not like we'll have a website or anything. Just pick some numbers and I'm okay, 365 days in a year. There was no thought to it of any kind. And here we are.
Well, not to jump the gun, as I am more interested ultimately in the journey than the destination, but how would you describe 365 Holdings today? Just, where the business is, kind of set the stage a little bit.
Yeah, quite different than that version 1 that I just talked about, or even maybe the version 2 that was the scale up. The version 2 that was the scale up was really a thesis around brands that are very small, called a micro brand, needing the internet as their primary means of distribution and the internet enabling that. And there being a long tail of a high number of durably profitable consumer products businesses that were native to the internet. The vision that we decided to scale up was to acquire these, run them pretty centralized, kind of a conglomerate business model, and try to acquire as many as we could. This is a bit before the aggregator craze and the Amazon FBA roll-ups and stuff. Slightly before that, I have a friend down in Charlotte who he kind of gone this route. He inspired me to do this to a degree. But that's kind of version 1. And as time played out, we realized all the challenges with why that was not necessarily a great business model. So fast forward to where we are today, and it's much more pursuing a traditional decentralized holding company. Happens to be concentrated today in consumer products businesses, but the vision is really just to have a portfolio of independently owned and operated businesses under a common holding company. And our focus is less about, is it a brand and is it e-commerce, and more about, is it a really high quality business or not? So today, I think we have a handful of high quality businesses. They all still happen to be in e-commerce. I think as time goes by, I'll look to diversify outside of consumer products and into other business models. Yeah, what started as a vertically integrated conglomerate has quickly changed into a decentralized traditional holding company.
And realizing this may be a tall order, but just pulling on the e-commerce thread, could you help set the stage for e-commerce and how you came to understand it, how you've seen it evolve as a distribution channel over time, working with as many brands as you have who are utilizing it? What is e-commerce exactly, and what is your perspective on it?
I think the reason I was interested in it was I saw my own purchasing patterns moving more and more online. I think my really quick and dirty view of it today is there's essentially two ecosystems. There's an ecosystem of demand capture, largely dominated by Amazon. So I have a thing I want, I need to go get it. I want it to show up at my door quickly. So I type it into Google or Amazon, or maybe here shortly, ChatGPT, and I need this thing and I want to buy it. On the other end of the equation is demand creation businesses. So these are classic businesses driven by advertising, really unlocked through Facebook and Instagram, and to a lesser degree now, Snapchat or TikTok or other platforms, but places where you could interrupt a consumer and offer them a product they didn't know they wanted or needed. They decide they do want or need it. They come through a customer journey, probably on your own website, and buy something. Really, it was the advent of social media advertising that really allowed that to be a thing. If you wanted to make the world's best organic peanut butter or a certain shoelaces made from vegan materials, pick your obscure product category, you can now reach customers that wanted to hear about that thing thanks to social media advertising and storytelling on the internet. And so I just thought there'd be many, many of these. I think there are, but the competitive dynamics within e-commerce are just absolutely brutal. And there's not a lot of excess returns on capital. And particularly the big tech players, Amazon, Facebook, Google, et cetera, are really good at extracting all the economic rent out of that ecosystem. And so it's very hard to get a durable stream of cash flow out of those businesses if you're not going to run them kind of in founder mode And by definition, we're not running in founder mode. We're running in like micro private equity business guy mode. We're going to go take this thing that somebody else started and like see it onto this better future through scale, through a team, through shared services, through our experience. And a lot of those businesses really, frankly, don't survive the founder mode. They really need to be more owner operated. It's hard to institutionalize things like merchandising, product development. Those are really the hardest ones. It's easier to institutionalize customer service, advertising, web development. We're pretty good at that stuff, but it's hard to find businesses that we can acquire where the real soul of the brand, the products, the innovation, what customer needs we can meet can really be done on a scalable basis. For most widgets, you can just go to Alibaba and import one from China tomorrow and you're in business. So finding businesses from our perspective that really have a moat is really, really hard. That is one that we can both operate and is also worth paying for. And we're not going to have a disintermediation risk of somebody else coming in and just spinning it up tomorrow. So in the portfolio today, my favorite businesses are the ones where we have a really operationally intense supply chain. And it's a really defensible business model because it'd be hard to just go compete with us tomorrow. In the size of the market that we're in, the competitive position that we have, we've got a pretty good business model to capture as much of that market share as we can. And it'd be hard to just compete with us tomorrow because of the supply chain and scaling up a new operation. So I think for us in consumer, the future is probably more of these niche products where we dominate a market, we own supply chain or we own manufacturing in some way, because I think everything else largely ends up at a commoditized kind of Amazon type of product experience. And there's very, very few businesses that we can find that don't require us to be that founder kind of expert in that brand.
Lots of threads to pull on there. I think the one I'll pull for the moment is when you think about what makes for a good e-commerce acquisition target for you. You kind of outlined this durable competitive advantage, just strong brands.
Today, that only comes from two places. It's either the supply side or the demand side. So on the supply side, it's got to be product development, manufacturing, supply chain operations. Like, how do we make the thing? And you almost have to make it, because if you're just ordering it from a factory, then anybody else can order it from a factory and slap a label on it. On the other end is the demand side, advertising, content creation, storytelling. Being good at both is really what makes for a quality asset in our view, particularly if it's a transferable business where our team or a successor owner can still do both in a sustainable way. Those are the two components in my mind of like boiling down to the essence of a consumer product business. Supply, demand. How do we make the thing that nobody else can make? And how do we market it in a way where we can be competitive?
How do you navigate the actual acquisition of the company and working with the founders who've, maybe gotten it to where it is, but aren't going to take it to where you believe it can be?
That's my job. That's what I'm here for. I don't do a lot else anymore other than try to find new opportunities for the team. Yeah, we look at businesses that are listed publicly from brokers. We've done a number of kind of turnaround deals for businesses where it's a good business model, but there's a balance sheet challenge. We've done like lender foreclosure deals. We've done a few transactions helping people avoid bankruptcy and try to turn around these balance sheet challenges. But deal flow comes from a lot of different directions. Some of it comes inbound. Some of it's, again, actively marketed by brokers or bankers. But I'm always looking for other brands that we can own and operate.
How would you say that you have gotten better through subsequent acquisitions? Like, what are the earned lessons there? I have to imagine, the first acquisition looks very different from the one you're running today. How have you, maybe formalized those lessons that would inform something like a playbook, if you have something like that?
Yeah. The team keeps asking for the playbook, and I keep telling them I'm going to write it down, but I'm not going to, because as soon as I do that, they don't need me anymore. I like to keep it up here. The bar for the standard of quality of what we judge to be a good business keeps rising. So I've seen a lot of things, made plenty of mistakes in acquisitions, lost money on all kinds of different deals, lots of different ways. Every chart goes up until the right until you own it, and then it doesn't anymore. And I've just seen enough to know pretty quickly if it's a good quality asset for us. And then the challenge has become I'm not finding as many of those businesses anymore that I'd like to own. And it's harder to find them. They're fewer and farther between. The last 12 to 18 months has been rough. Valuations are compressed. Balance sheets are real messy. Seller expectations versus market prices for assets are really disjointed right now. So we've been doing mostly distressed, mostly balance sheet issue kind of transactions. Very few looks at things that are good, healthy, growing, going concerns because there's not that many of them.
How do you kind of marry that with the focus on quality and kind of the durable competitive advantage?
That's what we're looking for. And I think our lens of what meets those criteria just gets sharper and sharper. And what Kelcey of 5 years ago might have thought made for a good business is not what Kelcey of today thinks makes for a good business.
And is that due to changes in the dynamics of markets or due to your understanding of what makes for a good business?
Some of both. I used to think that we would drastically improve most everything that we bought. We were smart. We had all these ideas. We're going to do all these things. And now I largely think we'll be iterative. We will not be revolutionary. So if you've never run Facebook ads, I'm probably not going to start doing it after I buy your business. There's probably a reason why you haven't done it. You're a founder. You're pretty smart. You've run this asset. It is unlikely that that's a great idea of just volumes of untapped potential. I'm picking on Facebook ads. You could insert any tactic here. But by and large, we're not going to come in and do something revolutionary. Might do something iterative, but probably not revolutionary.
When you think about ameliorating these brands that you're bringing in-house, what does the shared services kind of model look like? Like, how do you parse the learnings of best practice across the portfolio in application to a new acquisition that comes onto the platform?
We used to share lots of things. It used to be like a very conglomeratized, fully shared services model. Now, looking more like a decentralized holding company, the only shared services is really executive management from the founders, HR, accounting, and like true IT. Pushed down to the brands is all of their own ops and marketing, which again is kind of the core of what an e-commerce business should be. So whether the brand is run by a leadership team or run by a general manager or CEO, that brand is responsible for its products, its product development, its supply chain, its operations, its customer service, all those things, getting product in, and then all the marketing, sales, and distribution, getting product back out the other side, whether that's on Amazon, direct to consumer, wholesale, whatever those channels might be. None of that is shared. I think that we still have opinions from the holding company level of what we want to see happen as the vision for a business and what we think is a good framework for decision making. But those activities are executed at the portfolio company. There might be shared learnings or shared insights, but the work is done at the OpCo level.
So to the degree a company hasn't done Facebook marketing and maybe it doesn't make sense to as a consequence of that, if it hasn't gotten them to where they are, I'm curious how you think more just holistically about omni-channel, right? If a lot of these are e-commerce as the distribution channel at the highest level, how you think about what it looks like between D2C, Amazon, Shopify as a platform. There's a lot to unpack there, but the different channels.
Most product categories have certain DNA around how customers buy them. The first biggest fork in the road is whether the product is bought or sold. If it's bought, you're capturing demand. Customers go looking for it. If it's sold, you're creating demand and you need to tell customers that they want it, interrupt them with advertising, convince them to buy it. That's the first big fork in the road. Within demand capture, you've got Amazon and Google as your primary digital channels. You got shelf space as your kind of real world channel. And demand creation, it's content marketing, Facebook advertising, podcasts, those kind of things. Less so a play on omnichannel unless you've reached some real scale and there's some real brand awareness. If you're talking about running Super Bowl ads and stuff, cool. You're big enough that you can have pop-up retail and you can be on the shelves at Target and that kind of stuff, but you're at a different scale there. for a small business, 1 to 50 million of revenue that's selling a consumer good, you're very, very, very likely either demand capture or demand creation. If you're demand capture, you probably can't do demand creation. If you are demand creation, you likely have a limited amount of demand capture. So, easy example, I'm wearing a button-down dress shirt, as are you. You and I might go looking for men's button-down dress shirts and find a million people selling them. Or you and I can get an ad of somebody that kind of looks like us that says it's the stretchy one, and I bought it because I'm going on this vacation, and like you and I decide as young guys that we need to buy a new men's button-down dress shirt. There's a certain limit of how many dress shirts get sold in a year. There's a competitive dynamic of how many people go looking for them and fall in that demand capture bucket of I'm going to search for it versus how many people are sold them through demand creation of a new size, new style, new fabric, making somebody decide they want to buy something. But those are really kind of the two buckets. I think about everything through that lens of, is it bought or sold? Is it demand capture or demand creation? And that really kind of fixes your total addressable market for that consumer product category. Shy of being Elon Musk and inventing flying cars, which is a whole new market, which is not what we're talking about today, the vast majority of consumer products fall into these known markets that have known sizes and known dynamics for how they're bought or sold.
Yeah. In the spirit of this demand capture versus demand creation framework, are there other frameworks that you have as kind of guiding philosophies to how you think about the business?
That's definitely the biggest one. I think the other one is that's helpful is when you get to a business of some good age, 4, 5, 6, 7 years old in e-commerce, we've got like a long amount of history, starting to really look at non-subscription based businesses. So subscription sexy. If you can get somebody to auto ship every 30 days, it's great. Like that's a known thing. Let's leave that behind. Go back to the shirt idea. How often do people rebuy their shirts? And what's the customer lifetime value and the cohorts and the repeat purchase rate and all this good stuff? I'm not saying that from the perspective of we're going to build this CAC LTV model and go raise a bunch of venture money and go public because we'll eventually get paid back. I'm not saying it in that regard. What I am saying is buying an older consumer products business probably means you've got a big customer file. You probably can do marketing and product development activities, emails, SMS, product releases to reactivate your existing customer base. They're not totally lapsed. They will buy this season's new dress shirt. That's not really a venture scale game, but I can go in the hole and lose money for a long time to buy future profits. That's largely not a good idea. But I do think that it's underestimated how long you can wring value out of a customer base. We've seen this in some of the turnarounds we've done. When there's an established brand name, there's established email, there's brand search, people looking for these products, there's a really good residual value of revenue from people who know about that business. And it's a really more durable than I think most people would expect if you've got any amount of repeat in the brand and any amount of longevity, 3, 4, 5, 6 years of doing good revenues. So that's important to us, is length of time. I'd rather buy a 6-year-old flat business than one that's just kind of on a rocket ship for 3 years. There's just more levers to pull on that older company.
What can you share about this distressed M&A experience that you've had? You know, if on one side and you were kind of starting with the strong balance sheet, the durable competitive advantage.
We've been on both sides. We've had our own balance sheet challenges for that's a longer story for a different podcast than today. But we've been on both sides of it. We've had issues. We've helped other people get out of their issues from what we've learned. At a very, very high level, if you're listening to this and you're a founder, CEO of some kind, you're running a business, the first thing I'd recommend everybody get really, really comfortable with is understanding their own capital stack, what they're guaranteed on, who owns what in the business, what lenders are involved, and being very aware of what obligations you have if you take on particularly debt financing. In today's world, it's really, really easy to plug in your Stripe account, your Shopify store, your Amazon account, your PayPal, or even just your retail merchant services terminal that you have at like a local cafe. And if somebody offer you money through your business, hey, press this button, we're going to wire you money, you're going to pay it back over these terms. It's kind of wild how easily available that is. Another issue is like corporate cards are often personally guaranteed. What I tend to see, to answer your question, is a lot of people don't understand how their balance sheet works in the event of distress. What are they personally guaranteed for? If they can't meet all their obligations, what are the creditors that are going to be interacting with them in what order? Who has seniority or priority? How do you negotiate through these things? It's a very, very tricky set of situations. Most people don't realize what they're on the hook for that's beyond balance sheet items. So we know we're on the hook for a personally guaranteed credit card. Founders don't often always know they're also personally liable for things like sales tax remittance, trust taxes like FICA and FUTA, payroll wages. There's a lot of personal risk that you have as a founder or executive in a business that might go past just what's obvious in the balance sheet. So certainly balance sheet workouts are their own art of getting everybody negotiated to a good outcome to save a company if it's savable. But if you're a founder or entrepreneur, understanding what your actual personal liability might be in a situation and how the different participants in the business and stakeholders are going to act is a whole interesting education that we've had the pleasure/unfortunate pleasure of learning in the last few years.
Hmm. So you mentioned a little earlier on the kind of rise in what you might call popularity of just this strategy overall of entrepreneurship through acquisition, aggregators, roll-ups, micro PE of some form or another. Might be a worthy detour to explore the HoldCo Conference in some capacity here. But I mean, it's a topic that repeatedly comes up in conversation. I feel like I don't go a day or two without someone bringing up the demographic reality that you have this aging entrepreneurial boomer population for all these businesses across America that don't have a good succession plan in place, and certainly overrepresented in places here like in Northeast Ohio relative to elsewhere. And really there's kind of just growing awareness about what it is that you are doing actually, and that it's a viable approach for some who might have this entrepreneurial bent to them. But I'd love to just hear your thoughts on just kind of the industry from that side of things and how it's been.
So I think starting 10 plus years ago, it wasn't a defined term. There was no like ETA moniker. Being a search funder or something wasn't really an idea, at least not that you could easily find information on. Whereas today, I would fully agree, whether it's HBR's Guide to Buying a Small Business, books like Buy Then Build, you go on LinkedIn or Twitter and you see influencers and gurus selling courses and information on it. Like it's very trendy and sexy in entrepreneurship, and for good reason.
Real mind share. Yeah.
Yeah. And it's a real thing. There is a volume of businesses that need to transact. I think my couple comments on it would be the statistics are what they are. The businesses that exist need to transact or they'll go away. Just the reality of things. That said, this was happening before it was cool. Maybe the numbers have changed. Maybe the size of the ecosystem is different, but this has always existed. It just wasn't maybe as defined as it is today. For people approaching it, I do think that the definitions today that have been developed are helpful in that they grease the skids of getting a deal done. So if you go down the rabbit hole and learn everything there is to learn about self-funded search, I'm going to get an SBA loan, I'm going to raise preferred capital, I'm going to buy 100% of a business using 80% leverage, 10% seller note, 10% equity injection. It's like very down the fairway SBA acquisition play. There's a playbook. You should just follow that exact playbook. Likewise, in funded search, I'm going to raise a search fund. We're going to have a 2-year search period. I'm going to raise committed capital. Those people get a step up in the new vehicle and we find an asset to buy. Like that's a playbook. And I'm like giving a rookie kindergarten level summary of both of those playbooks. My advice would be if somebody's approaching this from the outside is pick a playbook and follow it. The thing that I think is most frustrating is I have people that contact me, friends, people I've met at events that try to color outside of the lines in a way that makes it hard for them to get a deal done. The reason why these frameworks have been developed of here's how capital participates in the transaction, here's how we raise the money, here's what the deal doc terms look like, here's how sellers behave, here's how buyers behave, here's kind of the guidelines of what a market deal looks like. The farther away you get from those, the less likely it is to close a deal. There's a reason why those norms have been developed and tend to work. much like in venture, there's a set of norms that tend to work at seed, a series A, et cetera. If you're in the Valley versus you're in the Midwest, if you're in SaaS versus medical, like there's norms that people have come to expect in venture. There are norms in what is now search. And I think people understanding that and trying to really understand those norms and follow them will make their lives easier.
It is why I inquired earlier about, to the degree you have a playbook, your own, and why it's interesting. I think that
I would say we're an exception to that because we're
right.
very
No,
opportunistic.
Yeah,
we're very, very opportunistic, and I'm solving a different problem. So we've built something that works for us, and if I was starting today from scratch, I might have to approach that differently.
Yeah. What problem are you solving?
That we get bored and need new businesses to buy.
Yeah. Well, so in light of that, as 365 Holdings has evolved from more centralized, that shared model in the beginning, to more decentralized, where ultimately at this point do you see it going? Like where would you like to take it?
Yeah. Over the years, we've bought north of 20 different businesses. Some we've sold, some we've shut down. We have 6 in the portfolio today. We sold one last year. I think what we're going to continue to do is sell whatever the bottom one on the list is and constantly try to reinvest that capital into the best opportunities we can find, existing businesses or new ones. And then we're going to continue to want to do special situations. So if we find a business that we think we can operate well, and it's got a balance sheet problem, we're uniquely positioned to help that business turn around and live on. So we'll look for those opportunities because frankly, they're a good value for us as a buyer. Where we want to go with it, we want to just keep doing this. It's great to have a team that is really good at running these businesses. And there's certainly no shortage of them out there. I think our goal is to continue to grow the holding company, and we'll stick with that.
Yeah. Yeah. The follow on would be, what success looks like. And it's like, can you quell your interest in just acquiring new businesses? I don't know if it's a solvable problem.
Yeah, I think that having fun building a business with a business partner who I respect and enjoy working with a team that we've watched kind of grow up and become a really high performing group has been super enjoyable. As much as it sounds maniacal to talk about buying businesses all the time, we mostly operate. We might get 1 or 2 deals done a year. We might go 2 years with nothing happening. And so we certainly work hard as an organization, but I'm not some like greedy, money crazed, 80 hours a week slave driver that's only trying to buy the next company immediately tomorrow. I think that we built this business to create a lifestyle for our teams, for our families, for the community that we live and work in, to create a great business. There's these brands that need a home, and if our platform can be that home for them, then we like to buy them and give them a good long-term home. We're not trying to make them go public tomorrow. We're not trying to grow them at a certain rate. We don't have to hit some kind of funding metric to make them achieve some outcome. We're trying to just build a portfolio of these great brands. So I think running a great business without having to like sell my soul to do it is really what the version of success is that we're moving forward with and that we're on track for and that we're enjoying.
And to add, even some additional color to that, I did read your annual letters to the degree that they were available online, and I did enjoy them.
They're out of print for a minute. We'll get back on that soon.
But I can tell perhaps that you've enjoyed writing those. I just kind of could feel that from within them. But you did explicitly in one of them lay out the values as you've identified them as important to the business, as like 4 tenets of it: the team and culture, EQ over IQ, relentless
Winners
execution, winners
Yep.
keep score. I thought those were pretty awesome, and I'd love to, if you could just kind of walk us through those.
Yeah, I think at some point every entrepreneur founder gets some meeting with an advisor, and they're like, "You really should have like a vision and mission and values and stuff." And I think we heard that years ago. Like, yeah, it's fine. We'll get to that.
Yes,
At some
the
point,
operating
around around like 20 employees, we got to thinking it was actually important, and we should solve that problem, and we should like think about it and come up with a real answer, not just the corporate America answer that's on the wall. And so we probably spent a better part of a year trying to make something that was real to us as founders and getting advice from people we really respected about it. So we did land on 4, EQ over IQ, winners keep score, relentless execution, and team and culture first. And they really just embodied the kind of business that Justin and I want to run. Back to your question about what does success mean? Success means running an organization and keeping with those 4 values. Those are the things that are important to us. We think it's more important the way you relate to your coworkers with a sense of self-awareness than how smart you are. We think that we want to win a business and we need to track the numbers and be profitable and have accountability with what we're doing. We don't kill ourselves. We do like to work hard and we enjoy relentlessly executing against the business plan. Like these are the things that we want to do every day. And that's why we picked them.
You've mentioned this idea of raising the bar for quality, like almost a quality barometer over time, and both within and without, with regards to the team and with regards to the companies that you're acquiring. How do you raise your own quality barometer? What does that exercise look like?
I think it's been lessons learned. We've seen business plans we've made, formal or informal, projections or expectations about a deal or an initiative or a project or a product line. And it's easy as an entrepreneur to have like a salesman's mentality of I'm going to build this thing and everybody's going to love it. It's going to be great. And then like reality sets in. That's not always the case. And so I've gotten more discerning around the standards to which I expect things to work and the dose of reality that I apply to aspirations. The aspirations of growing a business, the aspirations of how profitable it should be, how likely the product line is to succeed, whether people are going to be interested in this in 6 months or 6 years. Just really thinking hard about the durability of it, not about the ability to promote or sell or grow it necessarily. Those things are important. Like we need to drive the business forward, but having a bit more of a sober view to the quality of what we're doing and the value it drives to customers, as opposed to the visionary sizzle that we can promote it with.
Yeah, it makes a lot of sense. I like that a lot.
And don't get me wrong, like every founder needs to like believe the dream and sell the vision. Like I totally get that. Asterisk, I try to be more conservative with that than not as time goes on to better set expectations and to get a more durable business model.
Yeah. I don't know why exactly, but if have you ever read The Art and Zen of Motorcycle Maintenance?
I've heard of it. I've not read it.
There's this whole bit that I was just reminded of as you were talking about that with regards to like quality and how it's when things go wrong that you often get to pay attention to it. Tell us a little about the HoldCo Conference.
So I've got a friend in town. His name is John Wilson, runs a family-founded home services business of like plumbing and HVAC and things like that. They're based in Akron. And when the time we met, we had like similar number of portfolio companies, similar team size, even like similar revenue-ish. And we'd met some other folks that were also building portfolios of disparate businesses, manufacturing, software, whatever it might be. And looking around at various entrepreneurial ecosystems, we didn't find what we felt like was a community or event geared towards what we were doing at the time. And so John and I started the HoldCo Conference. We ran it twice in Cleveland. Actually, subsequently, I exited that business, and John's got a new partner in it. I went this year. It was at Sundance in Utah. It was awesome. But it's really this event geared towards the HoldCo entrepreneur, the person running more than 2 businesses, trying to scale multiple 7- and 8-figure businesses and grow them forwards. Nothing wrong with focusing on a business. That's great. But if you have a software business, there's a software conference for you. If you have a software business and a trucking company and a medical billing business and an Amazon brand, like it's hard to find a place to call home, except for maybe HoldCo Conference, because you'll probably find somebody there who has done some version of all of that before. And so it was really just designed to uniquely address the challenges of small holding companies.
What qualities do you think in that kind of dichotomy between a HoldCo entrepreneur versus a single business entrepreneur? Like, what do you think are the differences in the mindsets or skills that you would consider important or crucial to running a portfolio of businesses versus a business?
One thing that happens in a portfolio is you end up with portfolio effects. So much like in a venture portfolio or a real estate portfolio or even just a stock portfolio, the distribution of outcomes is not equal. You'll have outliers to the up and to the downside. So you have this constant capital allocation problem of your own time and attention, and certainly financial capital of what are we doing this week, this quarter, this month? How am I handling this group of businesses that I have? Which ones are growing? Which ones are maintaining? Which ones have challenges? And so you get this very different week or month or year of entrepreneurial operating when you're balancing kind of capital allocation as your primary challenge versus the focused company entrepreneur who's just going to grow their one thing. They've got this one boulder to push up a hill. I'm pushing 6 of them, but I'm running back and forth to whichever one is rolling backwards the fastest to try to get it to stop. While some of them are just taking off like a rocket ship up the hill. It's just a very different dynamic of that portfolio versus that focus.
How do you think about, given the real kind of divergent maybe goals of each company individually, the kind of overall incentive mechanisms that drive behavior at the portfolio level?
That's an active
earnouts, profit sharing. I know that those mechanisms matter a lot. There's a lot of divergent opinions on best ways to do them, just how you've come to your own philosophy on what that looks like.
We started with a very centralized, conglomerated profit sharing plan where everybody kind of got a share of the benefit. And as we've decentralized, we've also moved all of our incentives very decentralized to individual contributor scorecards and their own impact on their own business unit. And that's been a really good change for us. So I don't think we have it perfectly figured out at all, but trying to tie it as close to possible to the business objectives and to the levers that a contributor can pull to drive those objectives forward tends to be our North Star. So things like profitability, cash, P&L metrics is where we try to go to.
What are the accretive benefits to kind of very unrelated businesses as operating entities when you bring them together? Is there anything surprising about that?
Generally, there is no synergy. Generally, having a diversified portfolio is a good thing. It's kind of like portfolio 101, right? Is something zig when other zags. That's helpful. But other than lessons learned and maybe some institutional knowledge, there's very little from company A that really affects company B. And so again, back to my earlier comments of one day we might not do just consumer. If we owned a trucking company or a medical billing business or whatever, I think it would be the everything tastes like chicken layer of business. We have to have great people. We have to have a product or service customers want to buy. We need a delivery mechanism. It starts to get a little bit everything tastes like chicken, right? And so I think for Justin and I, being kind of high-strung, harebrained, easily distracted entrepreneurs, a new challenge is always exciting. But getting our team members who maybe aren't us, right? They're by DNA, they're team members, they're not founders. Getting them focused on something they can impact, something they value, produces better results for the organization, for their careers, for everybody.
Do you have a North Star inspiration, kind of proximate organization that you look up to? I mean, the decentralized kind of conglomerate model, Buffett or Munger kind of comes to mind, but is there an aspirational kind of organization that you think
it's
about?
definitely not Berkshire Hathaway. I don't want to be the world's richest man, and I'm not trying to do that. I really respect a lot of different holding company peers and friends. I've been to a number of events, both HoldCo Conf and others, where I've met people doing just the most fascinating things. I don't know that I have a good answer for your question of a particular organization we're trying to emulate. I think I want to just be the best version of what we're trying to be. What I enjoy, though, is meeting people doing it differently and comparing notes on the different ways we're all kind of doing similar things and seeing what nuggets we can glean from each other.
Yeah, I mean, sharing in the best of what other people have already figured out is kind of the fun of meeting other founders. Knowing that the aperture you might widen to do more than CPG, I am curious just your perspective on on e-commerce and where you feel it goes from here?
Well, we're recording this like 2 days before the China tariffs are real. So right now it's a total dumpster fire.
Yeah.
Today's April 30th. When this drops, I don't know. We'll have lots of tariffs or no tariffs, or it'll change probably. So right now it's highly uncertain, and it's a really rough operating environment. So my answer is very jaded at the moment of like there is no guarantees right now. Broadly speaking, aside from the current political climate and tariffs, I had been saying for a while, and you probably find reference to me saying this in the last year or two, that it's getting more competitive, and the rent-seeking big tech, Microsoft, Facebook, Google, Amazon, etc., are going to continue to pull value out of the value chain and compete profits down if you don't have a really good value prop. And so ecom 10 years ago was very hacky. You could earn an outsized profit through arbitrage and hacks, and a lot of that's really gone. And it's gotten to be more so of operating businesses that just happen to sell a product via an e-commerce sales channel instead of e-commerce marketers kind of hacking away at pockets of profit in the economy. So it's gotten more competitive. It's gotten more real business, if you will, and a little less hacky.
On the opportunistic side of your business, what have been the most kind of interesting opportunistic opportunities that you've come across when you think about that intersection of luck and preparedness, creating serendipitous opportunity? Like in the opportunities you can't prepare for, I'm just curious, like what have been the things that you've been able to encounter coming at them from the mindset that we can be opportunistic, that you've been able to do that otherwise, a firm with a very structured, strict, model would probably omit?
For us, it's been the distressed acquisition. So finding companies that have an immediate need for a transaction because of balance sheet impairment allows us to use the resources we have to move very, very quickly and get what is for us a very attractive transaction locked up.
That makes sense. What other earned wisdom do you feel is kind of most important that you've collected along the way that we haven't really touched on?
Touched on most everything. We probably haven't gone deep on all of it. But without a hardcore e-commerce or holding company audience, I don't know that you'll want to.
Yeah, that's fair. That's fair. I could geek out on cohorts and retention and kind of all that. The t-shirt versus the subscription model kind of businesses. Do you typically, within the bucket of CPG, has there been an area of focus, or is it really quite broad?
This year, where you got everything from custom stuffed animals to jewelry to do-it-yourself kombucha kits to pocket knives.
Amazing.
Like it's
yeah. Well, I'll ask then, what has building this business here in Northeast Ohio meant to you?
Ooh, I don't think I've ever been asked that before. What do you think I was going to say?
I don't know. That's why I asked.
Oh, I don't know if I have an answer for that one.
Beyond home, how do you think about it? Like, is to the degree that it's relevant at all to the business or not?
Ironically, Northeast Ohio has a great cost of living, so that's been a competitive advantage. It is not considered to be a hotbed of talent for e-commerce or marketing. That's been a competitive challenge. We had to figure out how to build some of those capabilities and recruit some of those people and train them up, which has been rewarding. But there's probably many other easy places to build this business, including virtually and completely remotely, would be probably a good start. And or places like Boulder or Austin or wherever, Los Angeles perhaps. But I think that this has been home for us for a while, and it's kind of where we are. So we took advantage of the low cost structure and built everything else.
Yeah, cool. Well, anything else you feel that's left kind of unsaid that that you think is particularly important?
You covered a wide range. I can't think of anything off the top of my head.
All right, cool. Well, we'll close it out then with our traditional closing question, which dovetails interestingly to the one we just spoke about, but for a hidden gem in the area. Completely unrelated, but something other folks should know about that maybe they don't.
I feel like I grew up in Menor, and I don't know. I didn't know we had a national park. I don't know. My parents didn't take me there, or I didn't realize it. But I think CVMP is great, particularly like the Kendall Ledges area. My kids love it. I like going there. Doesn't feel like you're in Northeast Ohio, frankly. It feels like you're someplace more exotic. So I'm a big fan of what we have in the park.
Yeah, parks are beautiful. That's an awesome answer. Well, Kelcey, I just want to thank you for taking the time, sharing your story. It's really fascinating what you're building here, and appreciate it very much.
Thanks for having me.
If any folks had anything they wanted to learn more about or kind of follow up, where would you point them online?
I'm easy to get a hold of. If you know the name of our website and how to spell my first name, you can probably email me. My social media is pretty easy to find as well. So if you find me on LinkedIn or Twitter, or drop me an email and mention this podcast, I'll be sure to reply.
Awesome. Well, thank you again.
That's all for this week. Thank you for listening. We'd love to hear your thoughts on today's show. So if you have any feedback, please send over an email to jeffrey@layoftheland.fm or find us on Twitter @podlayoftheland or @sternhefe, JEFE. If you or someone you know would make a good guest for our show, please reach out as well and let us know. And if you enjoy the podcast, please subscribe and leave a review on iTunes or on your preferred podcast player. Your support goes a long way to help us spread the word and continue to bring the Cleveland founders and builders we love having on the show. We'll be back here next week at the same time to map more of the land. The Lay of the Land podcast was developed in collaboration with the Up Company LLC. At the time of this recording, unless otherwise indicated, we do not own equity or other financial interests in the company which appear on this show. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of any entity which employs us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Thank you for listening, and we'll talk to you next week.